so many of the financial advisors that we work with will have retail clients in a 60-40 portfolio, which has worked for so long, and I'm sure will again in the future. But when you get a year like this, it can just be incredibly painful because you've got both equities and bonds kind of under a little bit more pressure than you're accustomed to. How do you guys address that?
Well, so I always think some part of our business, most parts of our business are really tough. You can't predict equity returns. You have to just look at history and see where you are on the cycle. But to me, bonds have always just been a very simple math equation. And so, we have had in our client portfolios for around 3 years, 100% of that exposure in ultra short bonds.
Awesome.
And so with a duration between a quarter and a half a year. Well, it's awesome this year because that portfolio is flat to down like 5 or 10 basis points. But the cost of that are the previous 3 years. A lot of our clients, when you look at that line item of ultra short, are asking, why am I not getting any return, off of this? And so I think it's important just to remember when we would walk through that math equation that, for example, the 10-year treasury, going into this year had a duration of 9, and let's say a yield of what, 150?
Yeah, 1.51.
Right. So with just like simple math for the viewers, duration, if you have a 1% increase in rates and you have a duration of 9, you're going to be down 9 plus your yield. So down like 7.5%. So we knew that when the Fed said they were going to tighten, we had no idea they were going to tighten this far, but we just knew that math equation was not a risk that was compensated. So we've just been sitting in ultra short, since 2018. Maybe at the end of the year, we have the ability to revisit that.